Hey, it's Elias and welcome back to a new video. So today I'm going to quickly talk about what happened last weekend. We basically saw a hedge fund get liquidated by force. Now, why am I talking about this? Why is it significant? Simply because that hedge fund or family office, we'll see that in the video, was worth several billions. So basically last Friday before the weekend, we saw huge blocks of sales on certain stocks for no obvious reasons, pushing the price of these stocks very low. Of course, this brought some panic into the market because people did not know who was this mysterious big seller suddenly selling companies that had nothing to do with each other. And so basically these huge selling blocks were caused by a hedge fund slash family office that was basically getting margin called and had to sell its position. So basically what happened is that this hedge fund was trading on margin and was using investment banks as brokers. So he was using Goldman Sachs, Credit Suisse, JP Morgan, Nomura, and he had margin with every single bank in order to run his fund. And he got to a point where he was margined to 500 to 700%. So literally, if he had 1 billion under management, he could literally trade with 5 to 7 billion asset under management technically. So this margin is quite similar to the leverage I would personally use on FX accounts and things like this. However, this fund, as I said, had margin with many different banks and was leveraged at 500 to 700%. And all these banks, so Goldman, JP, Credit Suisse, was basically allowing this fund to go further into margin for some time. And so what happened is that Goldman Sachs actually realized that this fund was quite highly into margin with them, and they were also in margin with many other banks, okay? And so basically what happened last Friday is that Goldman Sachs realized all the margin this fund had with them, but also realized the fact that this fund had margin with literally every single bank in town. So basically Goldman Sachs decided to margin call the fund and for the fund to actually deposit what was owed, okay? It's just like if you have a 10K loan with your bank and suddenly your bank asks you to deposit that 10K, they need it back, and you can't deposit that 10K. What is going to happen in the case of Goldman Sachs? They went for the actual stocks, the actual shares, in order to sell them to get the money back. So Goldman Sachs sold the required amount of shares that was needed in order to cover the liquidity deficit. And this is when billions of dollars of shares were dumped into the market. And so this hedge fund, that's in reality a family office, I don't know if it's a single family office or multi-family office, but a family office is basically a wealth management fund where they manage the wealth of a certain family or multi-family. So basically this fund was a family office, but generally speaking, family offices invest in a risk-averse way. So they do not want to take big risks. They invest in treasury bills, in bonds, etc. However, Bill Wong, so he was the person at the head of this fund, was managing this family office just like a hedge fund and taking more risky trades. And one thing to know as well is that family offices have less regulations and they don't necessarily have to report what they invest in. So this is where things got a little bit risky. So anyway, obviously the shares and the stocks that this fund owned were worth much less simply because billions of dollars were sold at the same time. So obviously the market had plummeted on the stocks they were holding. Now this is exactly when things get a little bit tricky, simply because Goldman Sachs was the first bank to do so. However, all the other banks that now will have to do the same are holding shares, are holding stocks that are worth much less. So that stock that was worth $100 last week when Goldman Sachs basically dumped them is now only worth $20, $30, $40. So that's why Nomura, an Asian bank that this fund was using, has reported large losses. Credit Suisse has also reported $3 to $4 billion in loss, all due to that one family office slash hedge fund. So what can we learn from this? And for me, it's investing on margin. So of course, investing on margin has benefits, but it also has drawbacks, and this is the clear example. So for instance, in my situation, I'm specialized in trading FX on leverage. However, the position sizing I use allows me not to be in the red in terms of margin and not to get margin called by my broker. And this is really the main thing you need to work on and the main thing you need to be aware of. So I hope you enjoyed this type of video where we actually look and we analyze what's going on at the moment on the market. If that was the case, please leave a thumbs up. If you have any single questions, leave them down in the comments. I'll read every comment. You can also send me a message directly on Instagram, which appears just here. I make a video here on YouTube literally every single Sunday, so make sure to check out my YouTube channel. It was Elliot. Have an excellent day. Peace.